Good morning, everyone. Thank you for joining us this morning. I think it's probably fair to say underinsurance may not be the most exciting of subjects on the face of it, or on the top of a lot of agendas. But certainly from an insurance perspective, it's a hugely important subject that can have some fairly serious consequences for businesses or landlords or individual policyholders when it comes to claim time. So today, the discussion will be led by my colleague, Chris Hackett. Chris is our senior claims executive, a former building estimator and surveyor, Chris, who moved into the insurance industry in 1996 with McLaren loss adjusters, before joining the RSA group as a technical expert and then into Thomas Carroll Leely 6 years ago. Chris is also a chartered construction manager and a chartered loss adjuster, so well experienced to talk today about the scale of underinsurance, the challenge, how it can arise, and how that could impact people at claim time. So before we start the hand over to Chris, some brief housekeeping matters. We are recording the webinar, and you'll receive a copy later this afternoon or tomorrow. During the webinar, there is a chat box, so if you have any questions, please pop them in there, and we'll do our best to answer those through the Q&A at the end of the session. There is a handout section on your panel, so there's access into the presentation slides. And if you can, there'll be a small survey pop up at the end of the session. Very grateful if you could provide us with any feedback from today. So good morning, Chris. I'll hand over to you now, perhaps just to start us off. So when a business has suffered a loss, say a fire or flood, how do insurers go about establishing whether sums insured are accurate and whether a claim is underinsured or not?
Thank you, Gareth. You're saying underinsurance is not exciting. It was very exciting this morning when my Virgin internet connection had collapsed. So that got the old adrenaline going. Today, we're very briefly, in the 40 minutes we have allocated, we're going to look at the following heads of claim that are shown on this sheet. And me trying to be a witty Chris, and like Chris Witty, I'm going to say, next slide, please. So how big is the underinsurance problem in Britain? Remember that the sum insured is decided upon by the policyholder. Underinsurance may mean that a valid claim can result in a severely reduced payout, with the shortfall falling to the policyholder to make good. As a comparison, the total value of underinsurance for all UK properties is currently estimated to be in the region of 325 billion. Compare this to the 372 billion that COVID-19 has currently cost the UK government. A much smaller issue is overinsurance, which we will review briefly later on in this presentation. Next slide, please. So before we look at underinsurance, let's define what a building is according to insurers. It's sometimes debated, but is mainly defined by the degree of affixation, in that will removing an item cause damage to the property, but it should correctly include the structure, services, drainage, septic tanks and treatment plants, fences, hard standings, swimming pools, retaining walls, etc. Essentially anything that is as built on the grounds of the insured property. So let's look at the value at risk now. The sum insured will reflect the absolute limit payable by insurers under the policy, and the onus is placed upon the policyholder to select the appropriate sum insured, and they may refer to an appropriate professional for all this purpose, such as an RICS valuer using the BCIS valuation tables. The value at risk also needs to include for the costs of demolition and debris removal, surveyor's fees, local authority and planning fees, and VAT. If your business is VAT registered, you can recover the VAT back from HMRC on the cost of repairs. And if the building is completely rebuilt, including the foundations, it will be zero rated for VAT purposes. A word of warning here, asbestos. If you have in your asbestos register recorded any great extent of asbestos in the property, this will result in higher disposal costs following a fire because the debris will have to be taken to a licensed tip. Next slide, please. Some issues with buildings. Is the building listed, built from stone, built before 1920, or ever had a proper valuation? How do we set about valuing a listed building? Modern buildings can be costed using actual data from the RICS new build records and insurers' own records for completed fire reinstatement claims. But you still have difficulties these days in selecting the right figure for listed buildings, as currently no castles are being rebuilt at present. Buildings are listed because they are of special architectural or historic interest. This means if there's a fire or other loss, special permission from the relevant planning authorities and agencies will be needed before building repairs can take place. In other words, there will be a local authority conservation officer involved, and any of you who have had dealings with conservation officers, you know how complicated they can make matters. This is why it's important to get an accurate survey or reinstatement cost assessment so that the building's insurance amount selected covers the full rebuild cost of the property. Some issues that I find with older buildings, if they're built pre-1920, they will be built to last. They will be more difficult to rebuild on a like-for-like basis and cost more. Similarly, with listed buildings, if they are made from stone, is the quarry from which that stone came still open? If you select a different quarry, the stone may be of a different colour, which may upset the conservation officer. The use of Welsh slate. Welsh slate is a quality product and is much more expensive than Spanish slate, which I would not recommend under any circumstances. And there are also difficulties you may experience if you have a building that is in a national park. I once was rebuilding a retaining wall in Cwmllwyd outside Abergavenny, and the National Park Authority insisted that we spend £2,000 on an environmental and bat survey to see if we would be affecting any roosting bats. Needless to say, we weren't, but we still had to spend the £2,000. Next slide, please. Is it a green building? These are much more expensive to build as they're structurally stronger in terms of the roof and walls, which are required to support the combined weight of the soils, the vegetation and water, together with the need for additional pipework to supply water to the plants on the roof. This will also need pumps to get the water to the top of the building if water pressure locally is insufficient. Let's not forget the green buildings are not new. If we look at older green buildings, such as ones with cob walls, which were constructed of a mixture of mud, straw and clay, and not so many of those in this part of the country, but lots in Devon, Somerset and Cornwall. Wattle and daub construction is a wooden wicker covered in clay with the use of more animal dung. They like to get their value out of their dung in the old days. And thatch. Thatch can be expensive, and equally if a conservation officer gets involved, they will suggest to you that you're not allowed to use reed that lasts longer because the locally used material is weak. Also, if you've got a thatched roof that needs rebuilding, conservation officer and building control may insist that you build it to the Dorset model, which will inevitably push up costs. Next slide, please. Buildings, have any alterations been undertaken since the last sum insured was checked? This is often missed. If the building is going to be extended, then please tell your broker or insurer before the construction starts, as the worst case scenario is a fire on the construction site which spreads to the main building. Even a small addition or extension may make a just adequate sum insured inadequate, leading to problems. Consider as well hidden services upgrades. You may have installed additional cabling within the building which you cannot see, but has gone in at a considerable cost. Equally, consider data cabling and Wi-Fi nest systems, which will be largely unseen, but will come at a high value. These need to be factored into your rebuilding value at risk calculation. Next slide, please. A not too infrequent problem is difficulty of access to the property. This will have affected the original building cost and will also similarly have an impact on any repairs or rebuilding works being undertaken. The rule of thumb is that there are additional costs to be considered for every complication involved in a project. As Gareth said, a number of years ago, I was working as an estimator, and at that time we were costing a planned new Snowdon cafe, not the one which was rebuilt, but we had to consider how we were going to get materials to the summit and the costs involved. The obvious route is the train, but there's very limited cargo capacity on the tourist steam train. It has very limited running days and times with cargo capacity during the tourist season. And once you've got your cargo, your blocks of cement and sand to Clogwyn station, the top station, there's still a 2-kilometre walk from there to the summit and a vertical climb of 300 metres. Needless to say, once we had factored all of these costs into our estimate, as the other contractors no doubt did, the project did not go ahead. Next slide, please. Has the building had an internal upgrade? Quality fixtures, fittings and finishes will always have a price mag to match. A good example is I dealt with a claim for a shop fitter a number of years ago who operated from a modern standard steel portal frame composite clad building, but he had fitted the interior out opulently as this was his shop window for showing to prospective clients. The fit out value was as much as the rebuilding value for the main structure, and this would not have been picked up by a desktop evaluation using Google Earth, so it could have resulted in a major underinsurance issue. At present, consider what improvements you may have made or will be making now we're coming out of COVID. Are you going to be upgrading your canteen, including a fitted kitchen with increased services perhaps? Installing mezzanine floors to spread staff out further? Installing air conditioning plant to increase the circulation and the purification of air? Computer cabling and data floors installed to upgrade IT to allow for the management of home working. All of these costs need to be factored into the rebuilding value. In terms of tenants, remember to check the wording of any leases that are applicable. You need to check, is the item in question a landlord or tenant's responsibility, i.e. who has primary insurable liability? Is the position modified by the terms of any lease? Now, for example, I currently have a claim where one of the items being debated is £10,000 worth of stuck down carpet. Now, as we discussed earlier, a building item is deemed to be by degree of affixation. If the carpet is stuck down, you cannot remove it without damaging either the carpet or the building, so it becomes a building item. The lease is silent on who owns the carpet or who will be responsible for it when the new tenant occupies the building. So I'm now in a situation where the tenant, the new tenant, is refusing to pay for it because he has no legal title to it. He didn't purchase it after all. And equally, the landlord is adopting the position that it is not their responsibility as they didn't have it installed. However, we need the carpet fitted to allow the business to reopen and commence trading. That's one of a number of minor issues on that particular job, so it is worth looking at the lease. Next slide, please. Buildings, again, often overlooked external features. As we saw earlier, the policy defines buildings to include car parks, roads, pavements, and similar surfaces, all constructed of solid materials. landscaping, excluding external ponds and lakes, all being the property of the insured or for which they are responsible and situate at the premises. External features, as I say, are often overlooked, so remember to include in your rebuilding calculation costs for hard paving, steps, walls, lighting, and not seen but often forgotten are drains, and these can have a considerable impact on the sum insured. Above ground, all you will be able to see is a manhole cover, but what lies below the manhole. If it's a septic tank, it could have a starting value of £15,000. If it's an attenuation tank, possibly £75,000, or a water treatment plant could start at a cost of £150,000. So those are starting costs. The final figure, depending on the size of the installation needed, could be considerably greater, easily missed because potentially all you can see above ground, as I say, is a manhole or a series of manhole covers. One area that I have experienced problems with over the years are retaining walls. In essence, a retaining wall is only visible as a nice brick or masonry elevation, but behind it, behind the visible face, there could be a considerable amount of civil engineering works, which will come at a cost. The retaining wall is a structural element and needs costing as such. And also, as we move into the bright new future post-COVID, be mindful for the need for electric car charging points in car parks, because apparently within the next 10 years, we will all be driving electric vehicles. Next slide, please. Buildings. Has the building been insured on the basis of developers' costs? Developers keep costs to a minimum by using their own team of consultants and contractors, with preferred suppliers giving preferential rates for large volume sales, resulting in cheaper construction. By building en masse and repetitively, savings can be achieved by a developer that would be not available in an insurance claim situation, where the post-loss rebuild operation will necessarily be a one-off. Also, as we have seen previously, demolition costs and associated rebuilding professional fees will not have been included in the developer's costings. Developers' costs can only be used as a rough guide at best to value at risk, but not in isolation to all of those costs that insurers need to be included in the building sum insured. Next slide, please. Buildings. Has the sum insured been set on a market value? This is a problem that affects domestic policyholders more than commercial, but I have also found it in commercial situations. I cannot stress strongly enough that the insurable value at risk figure for a building bears no relationship to its market value. Market value reflects in large part the attractiveness of the location and the quality and the usable life left in a structure. A 3,000 foot square building, it should be metric, of course, we went metric in 1971, building in the regions will be much less to purchase than one with the same floor area, but based in a city region with good transport links and availability of labour, would cost pretty much the same to rebuild following an insurance claim. Insurers do not include a value for the land upon which the building sits, just what is built upon it. You cannot deduct a notional land value from a value at risk figure, as I once had a policyholder trying to do in order to make his sum insured nearly adequate. A nice try, but didn't work. Going back to potential overinsurance, the beach hut is a good example of why market value is not the basis for a value at risk. This hut in the photo is probably worth £1,500, including debris removal, so it's been marketed at £325,000. If it was insured for the market value, clearly it would be grossly overinsured. Next slide, please. Moving away from buildings to machinery, plant, and all other contents, when the adjuster arrives on site, the first document he will ask for is the asset register, and he will need this for his investigations. And I have encountered many instances in which values for items are included as the annual written down value, so making an easy assessment for the adjuster difficult, as you really have to reverse engineer the figures over the depreciation period to try and calculate the original value, which is what the adjuster needs. Keep a record of original purchase values and an electronic file of invoices too, because you'll never know when these may come in handy. The adjuster needs to know the original purchase values. Any specialist delivery costs will also need to be considered, such as craneage for heavy items and specialist installation charges. Remember as well, if you purchase a second-hand item, it should be insured for its full replacement value. For instance, if you buy a machine knocking out widgets at £500,000 because it was a good deal and a new one will cost £1.5 million to replace, if it's lost in a fire, do not insure it for £500,000 because you may not be able to source one for that value in the open market again. Insure it for its full replacement value. Insurers can apply an annual increase to the sums insured, but this will only be on the items they have been given a value for at inception. So let them know of any new purchases or upgrades which you've made during the course of the insurance period. Next slide, please. Stock. Stock should be straightforward, and the adjuster will consider stock in 5 categories. And these are retail stock, so what is on the shelves to sell, wholesale stock, bought in bulk at cheaper rates, manufacturer's completed stock is ready to sell but not just yet because it may need wrapping or boxing, manufacturer's work in progress, which is a bit of added value to purchased items, or manufacturer's raw materials and sub-assemblies, those that are purchased from suppliers and sit on a shelf. Always consider the last physical check and value date, and have this year is a good example of new lines purchased. Have you taken on additional lines since you advised your broker or insurers of the stock sum insured? Seasonal increases are often allowed for within policy wordings these days, but can catch people out, especially in retail situations where stock levels may be ramped up significantly, be it for religious festivals. And have you made a bulk order or stockpiling purchase because you're getting a particularly good deal on a product? Obsolescent stock is a difficult one for adjusters to deal with. If we take the example of out-of-season dresses, which cannot be sold as they are no longer trendy, can these be sold to the few who just don't care about fashion? Probably not. So the adjuster may value them as their realizable value, so how much a salvage dealer would pay for them, or a rag merchant, or even these days by reference to eBay. And recently looking on eBay, you can get 20 dresses which were retailing at £200 each, boxed up for the princely sum of £45. If you have got obsolete stock, make sure it is valued correctly and reflected on your sum insured. Next slide, please. Business interruption, which is always a thorny nugget I find in my working career. Business interruption relates to the consequential loss of income as a result of property damage. For example, imagine a retail newsagent who has a front window broken. The shop front has to be temporarily boarded up for a few days, and during this period, the shop will still be trading, but customers may be put off by the boarding, thinking the shop is closed. As a result, the income of the business falls. Business interruption insurance is intended to enable the retailer to recover this reduction in income, but there is stress there needs to be some material damage indemnified for under the policy first. This is known as the material damage proviso. One area that requires particular consideration by ourselves is the indemnity period that you will need. Approximately 75% of businesses in the UK take the minimum period of 12 months, but in most circumstances, this will just not be enough. A good example is the building you occupy. If that burns to the ground today, how long is it going to take to go through planning, obtain contractors' quotations, clear the site, award the contract to the developer, get the building erected, services installed, machinery plant installed before you are back in there operating as you were before the fire? I would suggest it will be a period far in excess of 12 months. Again, business interruption sums insured are driven by the insured and should include for future trends. For example, in an extreme situation, a 24-month cover period with a claim made on the last day of cover, the BI claim could run for the full 24 months from the date of loss, so potentially ending 4 years after the policy is initially taken out and the sum calculated. Most insurers will allow the purchase of additional increased cost of working cover, which may be of significant assistance. For example, a specialist supplier might value their reputation sufficiently that they would wish to spend more money than a particular transaction is worth to ensure that they service a valuable customer and service to that customer does not suffer. Additional increased cost of work would also allow for the temporary removal of critical production machinery items from a factory and to be relocated in a temporary setting to allow trading to recommence. Such cover is included in standard BI cover, but to a much lesser degree, and it is advisable to take out additional increased cost of work. Next slide, please. Right, moving on, and just take a drink. What are the consequences of underinsurance? Since the Insurance Act 2015 was introduced, there is a requirement on the insured to make fair presentation. And there are 3 pillars of presentation as shown on this slide. Insurers and adjusters will use the internet to confirm details provided to them by the insured, especially these days as they are easily available from open source websites such as Google Maps and Street View. The latter has every photo taken and dated for most locations which are accessible by road, and they are easy and free to access for all. A good example of why it's not worth being a little economic with this truth is a situation I had involving the alleged theft of some wrought iron gates, which were allegedly stolen on a specific date. But by checking on Street View, I could see that the gates were actually not there in 2016, so hadn't been stolen in 2018, as the policyholder was telling me. This simple check took me 5 minutes, and it resulted in insurers repudiating the claim and the policy not being renewed at the end of the term. Local media will also have reports of fires and floods, and there are websites that archive reports going back many years for even the most local of papers. So keep details factual and accurate, and details should be provided in good faith to the best of your knowledge. We'll just save time and prevent issues should you ever have to make a claim. So what happens where the declaration has been incorrectly stated and there's a breach of the duty? In the rare cases where the insured has been deemed to be reckless, insurers will respond as though the policy has never existed. For example, a building is presented as vacant for no more than 18 months and is severely damaged in a fire. Internet searches by the adjuster reveal a history of complaints from local people indicating the building had been unoccupied for many years and had also been subject to several previous unreported vandalism incidents. All of the information was readily available and should have been made aware to insurers at inception. The outcome potentially could be that under the Insurance Act, the insurers could refuse the claim and act as though the policy never existed. They could retain the premium, and it would also leave the potential insured in a situation when seeking new insurance, they would have to tell the new insurer that they'd had a claim rejected and a policy cancelled, and this would make finding new insurance far more difficult. Next slide, please. Insurers do have the option to opt out of the Insurance Act provisions, in which case the provision of average would generally apply. Average stipulates that the valued loss is adjusted in relation to the degree of underinsurance. The example here shows that the agreed loss of £20,000 becomes £17,380 when average is applied, because the value of loss risk is established to be £350,000, whereas the sum insured is only £250,000. So the shortfall of £2,620 falls to the insured to make good in this instance. And I have dealt with claims where 79% adequacy would be good. I have had claims where adequacy is less than 30%. If you have a lower adequacy and a higher claim value, the problem is compounded greatly. Next slide, please. That is the end of my short piece here. Hopefully it wasn't too long. And we will now take some questions. Gareth.
Thank you, Chris, and yeah, pretty much on time. Well done. Sorry, I have to apologise. I had a slight system crash just after I handed over, so we're back in. So I'll keep an eye on the chat box. If anyone's got any questions, please come in. Perhaps just one from me, Chris. I mean, the stats from right at the start: 80% of properties are underinsured by an average of about 30%. So how can people ensure that they're buildings some insured in particular are adequate? You know, how often should we be looking at revaluations or the like?
I think if in a domestic situation, underinsurance should these days not arise. Most insurers give you block cover. So if you insure a house with a big insurer such as RSA or Aviva, they may give you standard cover of £1 million, which will cover most properties. And what you need to be aware, again, if we go back to listing, that really throws any standard system of costing out of the window. The BCIS operates a free online service to give you 3 or 4 attempts each year to calculate the sum insured for domestic purposes. Conversely, with commercial properties, it's far more difficult. Commercial properties vary in construction greatly, from modern portal frame steel tin boxes to people who occupy Victorian or older warehouses or workhouses. Really, in those situations, you need to refer to the services of a specialist valuation surveyor from the RICS. And I would suggest that that is money well spent. You can get simple desktop valuations done by surveyors who work on an online basis and will take measurements from Google Earth or Google Street View. These can be helpful, but again, as the shop fitting situation reflected, and the outside shell of a building may not necessarily be reflective of what that building contains in terms of cost.
Sure. Thank you. Keep an eye on things coming back in. We talked about the machinery and plant, as you rightly say. If you're buying second-hand equipment, you should be insuring it for full replacement value. I suppose that equally applies to not writing down valuations as you would maybe for your accounts for machinery that you may have bought new and might devalue over time. But of course, the cost to replace could still be significant. That differentiation between, I suppose, what you hold on your asset sheet and what you insure could be quite different.
Yes, and I mean, years ago I had one situation in an engineering workshop that as machines got to their end, the end of their useful life, they were just dragged to a quiet corner of the factory and left there. We had a fire, and the insured tried to include all of these redundant machines in his claim. Now that had the effect that they didn't appear in the asset register and grossly skewed the value at risk. So the adjuster needs to know how much you paid for it originally. They're not necessarily interested in your asset register written down value. because that should represent a figure which you could realise on the open market. So you just need to know how much you paid for it originally, and you can then, if needed, factor in an uplift for inflation or refer to the original manufacturer to see how much something would cost to replace now. But the original value plus an inflation rate will give you a much better chance of making sure that your sum insured is accurate.
Thank you. I've not got any more questions popping up in the box at the moment, so perhaps just give them a minute or two in case they're frantically trying to type. I know if they're like me, it might take a little while longer, but I'm just trying to, I suppose, yeah, this is something, Chris, that we in the industry talk about quite regularly as being a challenge. At claim time, it's a particularly difficult circumstance for a policyholder that may have innocently and generally have innocently set us insured, but are being told that actually they may not have adequate cover and their claim payment will be devalued, and that does happen on a reasonably regular basis, say across the whole industry. When you look at those stats, that 80% of properties that are underinsured, this is it's a regular occurrence. Is that right?
Yes, and the other impact that it has, if the adjuster is discussing with you and insurers the actual adequacy of the sums insured, it will delay insurers making a decision on liability. And then until insurers have given you the green light, you won't be getting any money from them. Now, if your sums insured are particularly askew or a little on the tight side and need to be assessed, that may take anywhere between 6 weeks, 8 weeks, and you may be left in a situation where you're struggling to obtain money from insurers. The sums insured are set as accurately as possible from the outset, then you've got a fighting chance of getting an early liability decision and some upfront money from insurers. And we at Thomas Carroll can help out in situations, certainly with my background in adjusting, that to pull the rabbit from the hat, you need both a hat and a rabbit, I would say. Where there is a huge degree of underinsurance, that becomes a colossal problem.
Thank you. Right, I've now found the correct question panel. So there are a few more that come in, Chris. So where insurers do not respond to a policy because of overinsurance by the policyholder, does the policy still respond to, for example, a lender that is a composite insured on the policy?
If there's overinsurance, then there shouldn't be a problem with a claim being accepted. But there's a situation potentially where you could say, may we have a return of some of our premium? To be honest, it's not a situation I have encountered very often. If you've got a lead insurer, if you're co-insured, they will generally seek money back. But I would, yeah, as I say, it's not the situation I come across very often. Yeah.
Okay.
Difficult one to answer.
Yeah, no, thank you. Chris, good morning. With regards to business interruption insurance, which essentially get you back on your feet, what happens if over, say, the 2 years you thought we'd take you to get back to that position, it transpires that there's no point, you now can't make a successful relaunch?
Yeah, the business insured period, it will be an absolute limit. So if it's going to take your business 3 years to get back on its feet, you're only insured for 2 years. At the end of the 2-year period, the money stops. It's as simple as that. The policy will cover, and for instance, if you need to go out and start advertising in the market to get your customers back, it will cover some expenditure as increased cost of working for advertising. So get your name out there to say that you're back up and trading and please come back. It will cover that. There's a limited amount of increased cost of working cover within standard business interruption, but as I said earlier, I'd recommend strongly you consider taking out some additional increased cost of working, because that value sits outside your standard BI cover and will give you a pot of money, a pre-set up pot of money with insurers to spend on additional items such as increased advertising, which may have only limited cover within the main policy. And expenditure, of course, on increased cost of working has to be economic. So insurers will always look at a situation, if they can spend 99 pence on advertising but gain £1 worth of income, they will do so. There's an economic test that needs to be set.
Thank you. Fair to say, within that, they'll effectively keep paying the claim until either the limit runs out or the time period runs out.
Yeah, one or the other, but it doesn't extend until you're back up to a position where you were trading prior to the loss. It is limited.
Okay, now here, if I suffer a major loss such as fire, how long does it usually take for insurers to investigate and confirm the sums insured are correct and deal with the claim?
Right, if we have a scenario where the sum insured is adequate and the fire doesn't occur on the weekend, because it's always a bit of a problem trying to get an adjuster out on site on the weekend, I would think on a large loss, say it's £1 million standard factory, that the adjuster will be out on the first working day following the fire. He will probably appoint forensics, because the insurers will want to see if there's a potential recovery aspect. So within a fortnight, the forensic report will be produced with any initial findings that they make, which will be there is a recovery or there isn't a recovery. They will also report on causation in terms of reference to any warranties. So oily rag warranty is the one that always springs to mind. Did you keep oily rags within 15 feet of the premises at the time of the fire? Assuming there aren't any warranty issues, there aren't any issues with the forensic report, then I would anticipate that with a fair wind, you will get an indemnity decision within 2 weeks, possibly 3. It's faster with smaller claims, slower with bigger claims. But where you have problems, it could be 2, 3, 4 months following the fire before you get a decision on liability.
Thank you, Chris. I think that's it for the question. Nothing else has popped up in this. So we were aiming to take around 30 to 40 minutes. So we're 45 from start to finish. Probably seems a good time to wrap it up. For anyone that any of our clients or partners or businesses that would like to have a conversation with with us around it, please feel free to get in touch. If there's any questions that you've got following the webinar, again, please feel free to drop them over, and we'll do our best to answer them. It's a generally underappreciated aspect of insurance that is absolutely critical to getting it right. The last thing anyone wants to be in is a position where claims are not being met in a way that you would expect. So I think today's hopefully been valuable for you all to understand some of the considerations that need to be considered when we're setting the sum insured. And it's one of those things that we get it right at the outset, then the claims process generally runs far more smoothly and with less stress and worry at that point as well. So a good time for us to wrap up. Chris, thank you for hosting and guiding everyone through that today. Very much appreciated, and we hope to see you all soon.
Thank you.
Thank you.